Broadly speaking, there are two different ways of analysing markets. There's technical analysis that we do a lot of on this channel, and there's fundamental analysis. Here we've got a chart of Tesla with a great trend. What do the fundamentals look like? How do you do fundamental analysis? How can you tie it up with the technicals? And is there a mutually compatible way to use both of these approaches? I thought we'd take a look at some fundamental analysis techniques in this video, and I'm going to break it down into individual stocks. We'll look at perhaps some of the runaway stocks like Tesla, what some would see as perhaps more cautious, conservative stocks, the like of IBM. We'll also look at fundamental analysis when it comes to foreign exchange. Whether you're looking at major economies, pound US dollar, of course, comparing the UK and the US economy in some way, or the slightly more exotic markets like dollar, Turkish lira, that has seen plenty of volatility over the last few days. So I'll talk about some of the main points, then we'll come back, dip in and out of the platform and look at this in a bit more detail. Hello, I'm David Jones from Capital.com, and I thought this time around we'd do one of our slightly different videos, taking a look at some of the basic principles of fundamental analysis when it comes to individual stocks and other markets like foreign exchange. So as usual, in this video, I'll talk a bit about the principles. We'll jump onto the platform and take a look at a few markets in a bit more detail and see how these principles may have played out. If you're watching this and you haven't subscribed, if you could click on subscribe, it does help support the channel. It means we can continue to push out lots of different videos throughout the week. And of course, we do these live streams now on a Friday, 2:30 UK time. If you're subscribed with the alarm bell notification switched on, you get a notification off YouTube about a few minutes before we're going to start the live stream. Anyway, let's get into it. Let's get into this idea of fundamental analysis. So broadly speaking, there are two types of market analysis. I think market analysts would tend to put themselves in one or two camps: fundamental analysis and technical analysis. We do a lot of technical analysis on this channel. I qualified as a technical analyst back in April 1995, a long time ago now, and technical analysis is a technique that's favoured probably more for traders, I think, when it comes to looking at short-term moves in markets, looking at charts, looking at trends, that sort of thing. But there's no reason why they need to be mutually exclusive. I don't think that charts move markets. It's traders and individuals' reaction to the underlying fundamentals changing or evolving that have an impact on markets and produce all the pretty trends that we see on charts. So in this, I think it's a useful skill to be aware of both market approaches. So let's talk about fundamentals in a bit more detail. So let's talk about it from a stock market point of view, first of all. So applied to an individual company, it's a way of trying to figure out what is the intrinsic value of that company. How much is it worth? So investors will use fundamentals to try and calculate what they think is the fair price, and then, of course, from that, the fair share price for the company, to try and figure out, well, is the company overvalued by the market compared to where the shares are trading now? Or actually, is the stock market undervaluing a company and maybe we should think about buying the shares? As you might expect, this isn't a one-size-fits-all approach. There are many factors that will go into the fundamental analysis of the company, and different investors will place different weight on some of these factors. So let's look at some of the more common ones. For example, a top-down view might look at the broader industry sector the company is in. Is it an industry that looks set to achieve great things over the next few years? Let's go back 5 years and look at electric vehicles, for example, and the performance of Tesla and other stocks since then, as the electric vehicle industry has been expected to expand. A slightly shorter term look, if we wound the clock back to March 2020, when we saw various lockdowns around the world, look at how well the so-called stay-at-home stocks have performed since then. The likes of Zoom, video conferencing, Peloton, exercise at home, and Netflix, binge-watching various mini-series sat on your sofa. So a helicopter view approach would be looking, first of all, at what the industry looks like and what its potential is. Then, of course, there's the profit of the company. That's an important thing. Is the company making money? How much money is it making? And also, is it increasing its profits? Has it just had a bumper year, but actually that's a blip? Or are we seeing this company continuing to steadily increase profits? And that's arguably more important than the profit today. Is how has it grown its profits over the years? And don't forget, of course, profit isn't the be-all and end-all. There are plenty of high-flying stocks out there that took some time to make a profit. So again, investors will be trying to calculate, well, what does the future look like for this company compared to where it is today? One way that investors will look at profits versus the share price is to look at the price-earnings ratio, the PE ratio. This may well be a term that you're familiar with if you've looked at any sort of investment research on individual stocks. So this really measures where the current share price is compared to the earnings of the company. We have a historical PE, how the company has performed historically versus where the share price is now. Traditionally, a high PE, a high price to earnings ratio, would suggest that the share price is expensive. But I think we have to place that in inverted commas. You're paying a lot for the company based on where its profits currently are. And then the flip side of that is traditionally a low PE, a low price to earnings ratio, would suggest that actually maybe the company is a bit of a bargain and the stock market is undervaluing it based on where its share price is. But again, let's not forget that plenty of companies' PEs can be high. Tesla is another example, and we'll take a look at these in a second. And plenty of companies have soaring share prices even though they're not actually making profits. So PE ratio is one way of looking at companies, but again, it's not some magic silver bullet. The management of the company can clearly play its part here. They're the board of directors who are directing and running the company. If they've had great success somewhere else, for example, in turning a business around, and they come somewhere, that's something that can appeal to individual shareholders and institutional shareholders. So the people involved, rather than just the numbers, can also have an impact. But let's take a look at all of this. Let's take a look at a couple of stocks. Let's look at PE ratios, see how the share prices have performed. Let's jump back on the platform. I thought, as an example of fundamentals, let's take a look at Tesla. We don't need the RSI because we're not talking technicals today. We've got a very clear trend in the Tesla share price. But some of the numbers that I've pulled out from Nasdaq.com, the earnings per share for Tesla for the last year, 64 cents per share is what it made. The share price, when I did the calculation, was around $667. So the PE ratio for Tesla is about 1,000, which for some would be off the charts. But actually, if we look back at it over the last 5 years, this PE ratio has ranged from 550 on the low side, which is still pretty high, to above 1,400. So I think if you're investing in Tesla based on PE ratios, the historical PE ratio, you probably never would have bought the shares. Compare this with IBM. So seen as perhaps a blue chip safe investment, here's the share price over the last 12, 15 months or so. Quite a bit of volatility, not surprising considering what the market's done. But looking at the numbers, earnings per share have been $7. Share price is around $130, giving us a PE ratio of 18. Very different to the Tesla PE of 1,000, but it doesn't necessarily mean that IBM's a better stock than Tesla. Obviously, if you'd invested in Tesla a year ago, you're sitting on much better gains than you would be for IBM. IBM, over the last 5 years, the PE ratio at the moment is 18. It has ranged from 9 to 27 over the last 5 years as the earnings and the share price have changed. So PE ratio is only really one part of the equation when it comes to fundamentals. There are other factors that we need to look at. Clearly, what's worked in Tesla's favor is the sector it's in. And of course, the management as well, Elon Musk, and the fact that over the last 12 months, it has actually started to deliver annual profits. Let's talk about foreign exchange fundamentals next. So let's take the discussion away from individual shares and look at a broader market. Let's take a look at foreign exchange markets. How might we try and figure out whether a currency is overvalued or undervalued based on the fundamentals. What sort of things do fundamental traders and investors in foreign exchange look at? Well, one thing they will consider, the obvious thing to consider if we're looking at the pound versus, for example, the US dollar, one of the things is the economy, the economic performance of that individual country versus the other country. You'd expect that if one economy is stronger and looks set to continue to perform better than another country's economy, then you would normally expect that country's currency to do better than the one you're comparing it with. So the relative economic performances, looking at things like GDP, gross domestic product, can be an important consideration here. But also we need to keep one eye on the future. Just because one economy is doing bad today, let's not forget, markets are not focusing on the present. Markets are always trying to look ahead. So what do the prospects look? If one economy has had a really tough time over the last 12 months, and I think at the time of recording, there are plenty of economies that are in that situation, what does the future look like? Are they going to bounce back faster than some of their competitors? That's another thing that, even though the fundamentals may not look good today, can make a currency more attractive than others if the future growth looks to be faster. But there are a whole host of other economic indicators to take into account, and these will tend to gain in importance at some times in the cycle and be less important. But for example, some obvious ones to look at: the unemployment rate of that country. How well or how badly, again, is the economy doing that? That's what that relates to. Things like inflation and interest rates can be incredibly important. At the time of recording, these are becoming more important for the US dollar. If interest rates have to rise because of inflation, that's something that can make a currency more attractive, or perhaps suggests the economy is in trouble. So there are all of these different factors that we need to look at. And let's not forget about the impact of central banks. So the US Federal Reserve, the UK's Bank of England, the Bank of Japan, the European Central Bank. Most economies will have a central bank who will sit there and set policy. So, for example, is the central bank likely to raise or lower rates? Is the central bank going to effectively print more money? We've seen plenty of quantitative easing over the years. QE since the financial crisis, in effect, printing more money into the economy. That's something that can put pressure on the currency. And the individuals leading the central bank. The major economy central banks, if their leaders or members of the policy committee are making a speech or say something that's a surprise, just a few words have the power to move financial markets. So central banks definitely play their role as well. Let's take a look at a couple of different currency pairs and see how the fundamentals played out and affected the markets. So we'll look at two FX pairs. The first one, pretty major one, pound against the dollar. And look at the move last year. So the pound against the dollar was trading around 132. So a pound would buy you $1.32. And then by the middle of March, it was down at 114. So it dropped, about 12-13% in fairly short order, dropping to its lowest level since the mid-1980s. So we saw, a 30-year plus low for the pound. And the fundamentals behind this here was the breakout of the coronavirus, the continued spread of the virus around the world. Other currencies against the US dollar got really hard hit because investors wanted a safe haven, and the US dollar ended up being that safe haven. So we saw other currencies dumped, as is the case here. Future outlooks on inflation and everything else went out the window. Investors were looking for somewhere safe to park their cash. And we saw, of course, the dollar strengthen, and here the pound against the dollar really dropped. Since then, the story has been one of a comeback. Investors have embraced risk, so they've turned back to what are seen as riskier assets, stocks, and different currencies other than the US dollar. And we've seen this incredible bounce back in pound against the US dollar. At the time of recording, the pound this morning has slipped to its lowest level for about 6 weeks or so. And what's behind this? We're seeing inflation concerns coming back in. Will the US have a more aggressive policy on raising interest rates? Will that make the US dollar more attractive? So we're seeing other markets like the pound, or other currencies like the pound, weaken versus the US dollar. So you can see how the different fundamentals will wane and wax in popularity depending what's going on in the bigger picture. So at the moment, at the time of recording, the first quarter of 2021, inflation and interest rates is what plenty of market participants are focusing on when it comes to foreign exchange fundamentals. And here's the dollar against the Turkish lira. And I thought I'd pick this one out because of some fairly drastic news that's broken in the last few days. So we did have, back in November 2020, a dollar was worth around 8.5 Turkish lira. By mid-Feb, it was worth 6.8. So the dollar had dropped in value. What we're seeing here is dollar weakness dropping by about 20% over that period. But you can see that the sharp rise in recent days. So March the 19th, a dollar would buy you about 7.15 Turkish lira. And the very next day, it traded up to 8.47. So a really big jump. We saw a 15% jump in the dollar, a 15% fall in the Turkish lira because the central bank governor for Turkey was fired. So clearly, I talked about how central banks have a big impact on markets. If you fire the leader of the central bank, markets can get spooked. So we saw, again, this leap here is the dollar gaining in value and people selling the Turkish lira. So we have seen things calm down over the last few days, but clearly short-term changes can have potentially a big impact in currency markets based on the fundamentals or a change in management. That's it for this dipping our toe into fundamentals, just to give you a taste of the different approaches when it comes to individual stocks and wider markets such as foreign exchange. I hope you found it interesting. We'll wrap things up there. So from me, David Jones and Capital.com, good luck with your trading. For more trading videos just like this, please subscribe to our channel.